Hey, let's have a look at how December 24 FR Exam examined deferred tax. So let's have a reminder of deferred tax. It's all about temporary differences. You're going to get taxed later, hence a temporary difference, not a permanent difference. If you're never going to get taxed, then there's never any tax. So it can only be on temporary differences. There's temporary differences between accounts and the tax rules. So maybe the IFRS says, oh, look, you show the income this year, where the tax rules say, oh, no, we won't tax you on that till future years. So the tax has been deferred, but you need to bring in the tax now because you've shown the income now, even though the taxman's not knocking on the door for it yet. You've shown the income, you need to show the related expense. It's a matching principle. So you will be taxed later. There is a temporary difference. So you've got to bring in the tax now, debit tax on the income statement, credit deferred tax liability on your SFP. Kind of makes sense. One thing though, because tax is in the future, you might be tempted to discount it. You don't. Okay, what about this scenario then? We know it's about temporary difference, but this time we're talking about expenses, which is always a bit harder to work out in your head. So we show the expense now, and the expense reduces your tax bill, doesn't it? The more expenses you have, the lower your tax bill. So that's a good thing. Shows the expense now. But the taxman says, oh yeah, but I'm not going to give you tax relief on that till later. You're not going to get the benefit until later. So it's a deferred tax benefit now, isn't it? So it's a deferred tax asset. And the double entry for that deferred tax asset would be debit deferred tax asset on your SFP, credit tax on your income statement. Reduce your tax on your income statement. Okay, let's have a look at the question. Basically some true-false statements. See what we think. Deferred tax looks at temporary differences only. We know that. That's true. Deferred tax get discounted down. No, they don't. A revaluation of land has no deferred tax liability. Well, think about it. That is false. It does have a deferred tax liability. Why? Well, the accounts are showing a gain now, aren't they? They're showing a gain because you've revalued the land. But the taxman won't tax you on that gain yet, will he? The taxman will tax you when you actually come to sell the land. So it gets taxed later. So we've shown the income now, we get taxed later, that's a deferred tax liability. However, the double entry is slightly different. It's not debit tax on the income statement. Why not? Because the revaluation of the land didn't go to the income statement. The revaluation of the land went to OCI. So to match again, the tax on that needs to go to OCI. And then you credit deferred tax liability as normal.